Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome back to the channel. For those of you who are new, welcome to the Greedy Trader channel. So here's where we learn everything about market profile. So for those of you who don't know, market profile is what 90% of the institutions out there use to determine their trades. So we want to focus on and we want to be paying attention to what 90% of institutions are doing, because that's how they're getting ahead, right? Obviously, being someone who's come from the institutional space, I can only tell you what I know. Once again, for those of you who've been following me for a long time, it's just another video. Alright, so I did say that I was going to talk to you guys a lot more about day trading this week and how we can do this and how we can make sense of it and essentially how we can make it work. Now, I've always had the approach that you need to have trading as a business. You need to have a degree of structure alongside how you trade. So, what do I mean by that? Essentially, one, you need to have a way of stabilizing your income from trading. Over leveraging, all of that stuff won't stabilize your income. It will put you in a very terrible mental space. You'll have a lot of wild swings with your trading. And to be honest, you're going to be discouraged. Your results are just not going to be optimal. And that's not the place we want to be as traders. Right, so by structure, I mean, one, you want to stabilize your trading. So first and foremost, position sizing comes into that, what kind of size you trade, also what you trade. So there has to be an element of swing and position trading if you're going to stabilize your trading in any way. Because not only does longer term positions take away the anxiety of trading, but also it means that the time you spend in front of the screen is less, right? So you can justify, the time you spend on trading. So in my opinion, you need to have that long-term view. For myself, that is selling option premium. That mimics a swing position. Obviously, it's not for everyone, but I understand the risks that come with selling option premium, but it's more stable income for me. So as a consequence, I don't have to spend a lot of time trying to over leverage in my trading. So that's first thing. So I have a base where I know the probability of outcome is very high. It's like 90, 95, 97% that I'm going to be profitable on any given week. I then combine that with the fact that I trade leveraged assets. So I focus on the most volatile stuff and I use market profile to tell me when to get in and out of things. I can manage an element of it from a portfolio standpoint. So that means I diversify all my positioning across multiple assets. I have stop losses that are planned against the week but executed within the intraday. That's one of the beauties of market profile, is that, for example, if I pop in here to a chart of gold, I can see, obviously, again, we spoke about this rejection in value. So we saw gold trade down, it got rejected into the new value area. So again, it didn't attempt to come into new value. So we had this massive divide between value centered up here and value below here, which is technically bullish for gold as we traded to the downside. So it became a buy the dip opportunity for a potential value trade. Bear in mind their offer stacks up here, right? So we should have a nice little run through. And then hopefully if we see sellers, we're going to see them at these highs, right? So again, if I was going to position long, this will be a typical long swing trade, and then I will position my risk accordingly, looking for much higher targets over a couple of weeks. I can manage that position in and out. I can decide to come out a lot earlier than my initially intended, basically what I'm trying to do is balance my portfolio so I'm consistently profitable in the portfolio and not really thinking about the profit target just yet, far out in time. What a lot of specifically retail traders, because institutions don't have this problem, is that retail traders think that they should only have an asymmetric risk profile, and that asymmetric risk profile, so that risk to reward profile, essentially is supposed to pay out all the time. They forget that actually, if you're in the right direction of the order flow and you can see yourself green on a day, then what's stopping you from taking the money and walking, right? You know, the market is not going to grant you this opportunity every day. So institutions largely think about the market in terms of probability. So how often, if I repeated this process, will I take money out of the market, as opposed to, well, my risk reward has to be asymmetric. Well, if you're an equities trader, then you're probably more likely to have that view than, say, if you're a futures trader or you're a currency trader, right? So generally, some market, because obviously equities have this ability to expand volatility because there are a lot of catalysts associated with the equity market space. So as a consequence, you can see a stock go from $1 to $6 in a day, right? So it makes sense to plan your trading based solely on an asymmetric risk reward profile, which essentially means that you're always going to guarantee that when you take a good position, you're either going to lose money by a small amount or you're going to gain money by a massive amount, because you understand the risk profile of your market, or the volatility profile of your market, is one that accommodates that kind of behavior. Well, of course, if you're going to trade something like, for lack of a better example, let's say corn, then you're going to stop thinking in asymmetric risk profiles, because essentially you'd have to be trading really close to the market, which completely reduces your chances of ever making a decent profit sustainably. So when you deal with markets like that, you start to look at risk and reward in a more symmetrical manner. So that's just how it is. And when you trade things like options, you really get that. You know, options that, you know, it's very difficult to have an asymmetric risk profile or an asymmetric volatility profile, because you simply just don't know. Your option could expand, but obviously options have a time decay element, so you're always getting hit by that theta impact. So your option, despite rising in price, is always more victim to declining more rapidly in price, right? So how the hell are you going to have an asymmetric risk profile when you can't guarantee that asset is going to go for longer than a day before it gets crushed? And you know that everyone knows the theta effect, so they try and jump out of it. So again, the point I'm trying to make here is, without dragging this out too much, the point I'm trying to make here is that you need to be able to to execute on a longer time frame within the smaller time frame, right? So essentially, you want to execute your trades using a longer term time frame, but also being able to execute within the short term. Now, of course, some people might do a top-down view analysis to do that. Obviously, from my standpoint, it's much easier to do. Use the market profile, just put up a weekly profile, and then look at just reduce the rotations to suit your time horizon, which gives you a more long-term holistic view of what's happening in the market versus a more macro view, right? So you don't have to waste too much time going top down, what happened in the monthly, the weekly, the daily, the 4-hourly, the hourly, the 15-minute. It's just too much effort, right? So market profile kind of makes it a lot easier for you to do. So that's that was the other bit. And of course, lastly, you have to be able to trade around core positions. So you kind of have to, one, figure out, okay, let's say I'm long gold and I see a good intraday short position in gold. Do I want to go in that direction, right? Again, that's you trading around your core position, but at the same time, you want to capitalize on any increased volatility. So that takes you relatively into the arena of day trading, right? So now you're no longer a swing trader, you're a day trader, because you're looking at daily intraday volatility opportunities, right? So again, depending on how you structure this, you start to give yourself a lot of opportunity to use your longer term positions to hedge out some of your intraday plays. So essentially you're trading around a core, and you can also essentially use some of the more guaranteed income to kind of make sure you're basing yourself so you don't have that anxiety or that pressure to make money from your intraday positions, which are going to undoubtedly be a bit of a seesaw. We're going to talk about that today as well, right? So hopefully this little bit here, this little segment here, makes sense to a lot of you. And if you haven't been succeeding in the markets, then that is probably the reason, right? You're either maybe too heavily intraday and there's not enough balance there, or maybe you're just too heavily swing and there's no balance there, right? And you basically don't have a way to access the market where you can get a little bit more stable income, right? So again, with equity traders, they probably might not have that issues too much because there are different ways you can cut. You can either come on the short side of equities and expose yourself to massive upside risk, which again, in my opinion, is a symmetrical, sort of risk reward profile, or an asymmetrical one in the opposite direction. And again, that's just the nature of equity trading, right? Or you can be long equities, and that allows you to perhaps attack the stock at a lower price and thus reduce that volatility impact, right? So there are different ways you can approach it, but you definitely need a more stable income to base. And also that's why people diversify across asset classes, right? So you might start off with something and then you want to move to something else. But again, if you diversify across asset classes, you can mitigate some of that, but you have to obviously you have to have a very robust trading plan in your mind if you're going to do that. All right, so let's talk a little bit today about my trades, right? So we spoke about the past 2 days, obviously intraday trading gold around a couple of my portfolio positions, right? So obviously I was flat on a lot of things in order to come in to play a little bit more on the intraday side, right? So again, looking at today, so once again, we started out European Open. So we spoke about that yesterday, is that you want to focus on areas where there's a lot of flow. So we started out European Open and we started to press lower. So you can initially see that push lower into deeper value. So we covered about 4 hours of value to the downside. And then we started to struggle to get lower. So you can see the interest on the buy side because we hit lower, closed up, however, not above the European Open, opened it close to the downside, showed everyone that we're probably going to go short, and then whipped us back up again. So it's quite a volatile morning. So as you can see from P&L on the screen, we started short, right? So based on our own trading methodology using market profile, we started short, and then we started to get that upside in interest. Now we were still holding from a risk perspective, we were still staying short, and then we almost looked like we're going to press lower. So time wise, that put us somewhere roughly about sort of 11 a.m. We thought we'd get the downside, and then we get this massive competitive buyer stepping. You can see the print in E period literally scooped this up, and then we just could not trade back down here, right? So for the rest of the session, we just started to hold in value. Now we did have a seller intervene, so the market was bracketed, and that tells you a couple of things. It tells you that, well, if the J period seller was to break, then we're going to get further upside. So it's a good execution level, which we finally did that, and we broke the high in Europe, right? So we broke the high and then we held, right? So that's an automatic long. So we're long, quick scalp over the next 2 hours to cover our downside loss, right? Typically, we don't want to see days like this, right? We want to see days that are directional, that we can really maximize on. Right, there are lots of reasons why we were in a short position. There were also lots of reasons, which I've explained, why we would want to be in a long position, right? So again, as you can see, 2 trades in a day. There should be no reason why on an intraday play, we have more than 2 trades in a day. If you have more than 2 trades in a day, there's something wrong, right? Now, it's very possible, as we're now in a US session, that we might get a big overload back into sort of European prices, and then we might, if you want to maximize on this, is try and stay short. But obviously being down on a day, so if you finish your day net down, right? On a good day, you're always net up. You finish your day net down, you don't want to overtrade it, because see, there's a couple of things that can happen. Is, let's say you had one bad trade, right? When you're playing these market, your risk reward profiles can be a little bit asymmetric. You have a lot of issues. You might have to take a lot of pain because there's no way for you to calculate what the short-term volatility is going to be, so you can accurately place those stops in an intraday. I mean, everyone knows that. That's why so many stops get hit. So you might be a little bit asymmetric, so you might need to know where to cut your position, and that might mean you'll eat a bigger loss than you'd want. Now, you will need the guts to go back in and perhaps recoup some of that, providing you've got a good reason to do that, right? So it's not a revenge trade. If you see an opportunity, you're able to recoup that. Now, let's say you had those 2 bad trades go wrong, right? And then you went for a third. You're increasing the probability that you're going to have a bigger loss that day because you haven't eaten those 2 losses. So let's say you have a good trade and then you have a bad trade, right? Then you probably, depending, you could be flat on the day or you're down on the day. You just walk away next day, right? Because you basically traded all the liquidity. The market knows what you're doing, right? The traders on the other end, they know what you're doing, right? Because again, it was very easy, like for everyone going short, they were getting trapped because the price action, you can see we balanced, right? And then we got competitive buying just below the balance. This is not indicative of a market that wants to go down. Now, if you're in a short position, there's nothing you can do about it. If you get out and then a big seller steps in and hits market, then potentially you could end up being basically getting crushed a lot lower, right? So in those circumstances, you would end up making money, but then you've jumped out of the position. So you don't want to do that. You want to kind of hold your risk parameter and say, well, look, I'm going the whole 9 yards, right? So again, the market can see that lots of people are trapped short. They're not letting go. We can see seller intervention. So the market's bracketed. Essentially, there is an agreement that this is equilibrium, right? Now, if that's going to break, someone's got to tip the balance, right? So we got to pay attention for that. And what do we get? Is that stepping in, someone tips the balance pre-US Open, right? And we can see that at 12 noon, right? So just pre-New York, someone tips that balance, right? So now we can see higher value perception. We're closing above most of the prices and we're holding. So you want to be long, right? Because now you can see an opportunity on a half standard DEV to walk away with some cash. You don't want to stay any longer. Of course, this market's still pressing higher. Great for the market. We don't care what happens after we're out one half standard DEV, right? I don't care what happens. I'm gone, because this is the best the market's going to do for me. If I take any other mindset, then I'm exposing myself to the market longer than I need to, and what that means is that I have a higher probability of a good trade turning bad or just plain blank losing money. So we want to spend as little as time as possible on an intraday in this market based on position, right? So again, the market can see what you're doing, and just like many traders are trapped short, they can see when, you know, those traders are going to get iced out, and everyone now knows they need to be long. So the behavior is constant every day. So if you realize that I was trapped short and I'm getting taken out to the upside above the European highs, and now the prices are locking in and we can see that change in perception, then you just want to get long, right? Just not a discussion, just get long, because that's all that everyone else is going to do, right? And then that move is going to get exhausted really quickly, because then everyone's going to take profits really damn fast, right? We're going to get a US Open. We don't know if it's going to keep going high. As you can see, the volatility is so peaked. You know, tickers going everywhere. It's 2:30. It's the Nasdaq Open, right? So there's going to be a little bit of a jostle. I don't want to be in the middle of this. Who wants to be in the middle of this, right? You know, this is not a tradable situation, right? So you want to get out, step out of the way, because you've done your ride in the European session. Now let someone else take that battle, right? Is this going to go higher? I don't know. Don't care either. Yeah, I mean, our weekly profile could tell us that we're going to go for a value trade, but I don't care. I've done what I need to do and I'm out. Now, if I'm trying to recoup my downside, or I'm trying to stay in or play more, then I'm going to lose more money, because that's not what the market is signaling right now. It's signaling that you need to be on the sidelines or covering and taking profits and getting out before another session kicks in and another idea plays out. Simple things, guys. Simple things can improve the way you trade. You're not always going to be profitable every single day, but these little things, they're going to help, right? So I hope this makes sense, right? So we'll talk a lot more about this in the coming days, right? But this is how we trade ended up today. So slightly down on the day. We've had 2 great days, and what I always say to guys is that if you get 3 winning days in a row, don't bother trading, because what happened, don't trade for the rest of the week, because what happens if you trade the other 2 days? It just means that if you have 3 winning days where you walked away with money in the market and then you traded those 2 additional days, and think about it, if you went down those 2 days, you're going to be trading more or less flat, or close to flat, or with a slightly, you might be in the green, but you're going to be down on the week more than you should have been. So keep the money and walk away. If you can understand, if you start the day and you get a losing trade, a winning trade, and maybe you're down on your P&L for the day, or you get it into a situation where you get 1 winning day, 2 winning days, and you kind of want to max it out to a third, that's great. But then again, if as long as you get 3 good days in a row, you have to assume the other 2 days are going to be bad days, right? Probability, guys. So again, 3 good days in a row, walk away. It's been a great week. Come back next week, rejuvenate, good to go again. Right? So again, it's just a way of ensuring that you stay in the game. Anyway, guys, subscribe, like, again, this is why we do this. So support the channel. Let's grow this, make it special. But till my next video, guys, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?